In 2025, real estate investors are facing a new kind of market. Rates are volatile, inventory is tight, and funding, whether you realize it or not, is no longer about surface numbers. At Phoenix Funded, we see deals every single day that look great on paper, and still don't get funded, and others that check fewer boxes but close, fast. So what really makes a deal lendable in 2025? Let's break it down. First, it's not just ARV and LTV anymore. Sure, lenders still care about the after-repair value and loan-to-value, but ARV doesn't mean much if it's built on bad comps. And a 70% LTV isn't comforting if the borrower has no plan, no exit, and no execution history. What matters more? Clarity, control, confidence in the borrower's ability to manage the deal, not just close it. Second, the exit strategy should be solid and realistic. Here's the truth, lenders don't lend on purchase price, they lend on execution. If your exit is to sell, we want to see a real resale plan, based on days on market, demand, and price trends. If your exit is to refinance, we need to know it's actually possible, that the DSCR works, or the long-term lender is lined up. What kills deals? Vague timelines, wishful thinking, no backup plan. A deal is lendable when we can see the whole arc, from closing to payoff, and it makes sense. Third, we need to see that the borrower has skin in the game, cash invested, collateral pledged, experience that matches the strategy. Even if the numbers are tight, a lender will lean in when the borrower is clearly involved, exposed, and prepared. What doesn't fly in 2025? 100% leverage with zero downside for the investor. Deals where you win big if it works, but the lender eats the loss if it doesn't. Lenders need to see alignment. Fourth, the deal should fit the market. A flip in a slow market with 120 days on market? Not likely. A rental with negative cash flow on day one? Pass. A value-add play in an area where the city hasn't approved permits for 8 months? Too much risk. In 2025, lenders are factoring in market dynamics more than ever. Inventory trends, demand cycles, rent-to-value ratios, and regulatory timelines. It's not just about the deal, it's about where the deal is, and whether the market will cooperate. Fifth, the file should be clean and the story should be clear. The best deals come with one-pagers that tell the full story: purchase, scope of work, exit plan, backup plan, and timeline. The worst, dozens of emails, missing numbers, no clarity. In 2025, speed is everything, and the deals that close fast are the ones lenders don't have to guess about. Let me give you 2 quick examples: a denied deal and an approved deal. First, the denied deal. It was a flip in an overbuilt suburban market, 75% loan to value, but based on stretched comps. The rehab was light, but the borrower had no contractor lined up. The timeline was, well, maybe 5 to 6 months, and there was no resale agent on board. On paper, looked decent. In reality, too many gaps. Now let's look at an approved deal. A rental acquisition in a working-class submarket, 68% loan to value. The property was cash flow positive. The borrower had 3 similar deals in the area. A property manager was already in place. Refinancing was planned with a DSCR lender post-stabilization. Not flashy, just fundable. At Phoenix Funded, we're not just looking for pretty deals, we're looking for deals with structure. If your deal has a plan, an exit, and a borrower who's prepared, we move fast. If it doesn't, we tell you why. Submit yours at phoenixfunded.com and find out what really makes it lendable or not before you lose time. Because in 2025, money still moves, it just moves smarter.